First of all, a recession was avoided because we were all staring down the winter of 22-23, and the Russian gas shut-off would have disrupted the European economies. And because, again, of a huge policy intervention, that risk was eliminated. And we are now looking at dealing with the after effects of Russia's invasion of Ukraine and the war which has been going on, and that caused energy price increases. That means monetary policy needs to be tightened. That means purchasing power of people has been reduced. Cost of firms has increased. And that explains and is the reason for the growth slowdown that we are expecting for Europe in 2023.
Well, the title of the World Economic Outlook this year is Rocky Recovery. And I do wonder where you see some of the downside risks emanating from in Europe right now.
One of the big downside risks is if we are not getting inflation under control, or if we get more surprises on the price side or more shocks on the price side. That is the biggest downside risk that we are seeing.
What about some of the financial stability concerns that have popped up in the last couple of months? We had a situation in the US, we had a situation in Switzerland with the Credit Suisse takeover. What sort of ramifications has that had, first of all, in terms of how you think about financial stability in Europe, but also in terms of the growth profile too?
Yeah, let me first go to the financial stability issues. We believe that the banking system in Europe is actually sound. Capitalization is strong, liquidity ratios are high, and it is well regulated and well supervised and can deal with financial stresses which arise during a policy normalization and a policy tightening cycle. But of course also what we need to take into account when we are doing monetary policy is that these kind of turbulences which may arise in the tightening cycle will affect financial conditions, and monetary policy needs to take that into account when setting rates.
What sort of growth impact do you see, though, from the tightening of financial conditions? Can you quantify it yet, or is it too early?
We expected for 23 and 24 that was shaving off in Europe 0.2% of GDP in terms of growth performance. So our forecast would have been higher by the same amount if these turbulences would not have materialized.
And in terms of the response, as we've been talking about, regulators, supervisors acted very quickly to put out the fire, so to speak. But do you think there is a message from all of this, perhaps in terms of how regulators are assessing the balance sheets of banks?
I think the big message in all of this is never be complacent. These are problems one needs to expect to arise during a tightening cycle. What it means for supervisors now is that they need to look at interest rate risk in banks, they need to look at liquidity risk in banks, and stress test those things. They have been doing this, but probably more is required right now in order to see where are the vulnerabilities, and then to take care of these vulnerabilities. I think that's an important part of taking care of financial stability issues.